While simple tracker funds are beating many of Britain's most successful fund managers, computer-run passive funds are doing even better when it comes to specific industries such as technology. Josh Alston from FE TrustNet thinks that though there are examples of success, these generally come in specialist sectors.
I wouldn't necessarily say it was a trend throughout the industry. I think that there's two quite distinct examples here of why this exactly happens. So on the tech side, I think it's more down to the fact that the tech index has proven very, very difficult to outperform, which is the case for a lot of specialist areas. So if you look at some of the less researched areas such as very specialized Asia-Pacific mandates, so, the Philippines or Malaysia, these are very difficult benchmarks to beat. So I think that the technology, on the technology side, is very, very different to look into the UK equity market, as an example. But certainly it gives a strong case for going for a tracker if you're looking for something that is in a specialist sector. Another example actually is I think it's the LNG pharmaceuticals tracker, which I believe is the best performing healthcare tracker as well. So it does actually extend to quite a few areas of the specialist asset classes.
Despite performing well, Josh doesn't see these passive funds as being able to be much improved on.
I think that a tracker is a tracker at the end of the day, and it's looking to replicate its chosen benchmark. So I wouldn't say that they're necessarily getting better. I think you could argue that they're getting better at replicating the index. There are certain trackers out there which have pretty much exactly replicated their benchmark. Those run by Vanguard particularly come to mind, and they've been very good at that. So I wouldn't say they're necessarily getting better. I just think that on the one hand, you've got this specialist area of the market where it's proving very, very difficult to beat the market if you're an active manager. This Vanguard FTSE All-Share, FTSE Equity Income Tracker. Now, this was launched at a time in 2009 when the market was very, very, basically it was on its knees. It was following the financial crisis, and I think what Neil Woodford would probably argue as to why he's underperformed is because a lot of the equity income market has rallied regardless of quality. It's been an area which has done very well because interest rates have been so low. So there's a lot of money has gone into income paying shares.
Wealth manager Jonathan Davies says that the lower costs associated with automated funds makes them very attractive and able to perform better.
The principal reason why low-cost tracker funds have been in recent years outperforming active fund managers is the clues in the title, low cost. They charge a good 1% per annum less than the active managers. And when the active managers, particularly in the last year or two, have become less and less confident of the continuing strength in the stock market, well, of course, they're going to raise their cash positions. They're going to have less in the stock market, whereas the tracker funds continues to have itself fully invested, and if the stock market continues rising, then it continues making more returns than the active managers.
Jonathan does think, however, that there are improvements being made in how passive funds are run, and this means people will continue to use them more, although the active manager shouldn't be discounted quite yet.
There is a groundswell of opinion that the Robo managers, the computer trackers, are becoming more and more efficient, and they're going to take over from active management in the long term. I think there's a very strong marketing case for them. There's no question about that. They're low cost, they're easy to access, people can understand them. So yes, there's going to be an ever-increasing market share taken by the Robo managers, the Robo advisors, that you can go online and say, just invest my money, I don't really care how you do it, just don't lose me money. And the Robo advisor, the Robo manager will act accordingly. There will, however, absolutely continue to be a major place for the active manager. They understand the markets. Computers don't think. I would always go with a human intelligence rather than a computer intelligence.
TrustNet's Josh Alston says that recent periods mean passive funds have done better, but depending on the timeframes looked at, the picture can be quite different.
It's arguable that actually looking at this time frame is quite fortunate for a tracker, which is looking at the UK equity income market, and that maybe if you look at it from now on, it might be a little bit of a different picture. We've had 6-7 years of pretty fast rising markets. So going into a tracker now where there's a lot of expensive stocks in there is not necessarily the wisest thing to do. So I wouldn't say it's reflecting a trend that trackers are necessarily better than actives. I think there's two different arguments there. I think on the one hand, active managers are being shown to find it very difficult to beat specialist areas of the market. And then on the equity income side, I think that it's a pretty compelling argument to hold that Vanguard fund because the charges are so cheap and it does give you core access to income-paying companies. But also I think you've got to be a little bit careful and looking at the time frames involved. The Vanguard fund has performed very, very well as markets have risen. If you look at the numbers actually over 3 years, Woodford is quite clearly on top as an example. So sometimes you do have to be careful with the timeframes that are chosen.
Quantitative easing and low interest rates have helped trackers to outperform active funds, though as human fund managers can anticipate likely change in the market's behaviour and reposition their portfolios accordingly in times of uncertainty, the autopilot is no substitute for a human hand on the tiller.